Exchange-traded funds, ETFs, have gained significant popularity among investors seeking a diversified and cost-effective approach to building their investment portfolios. As a relatively new investment vehicle, understanding how ETF investing works is essential for both novice and experienced investors. In this comprehensive guide, we will explore the intricacies of ETF investing, including their structure, benefits, risks, and strategies to help you make informed investment decisions. Section 1. Understanding ETFs. What are ETFs? An ETF is an investment fund that trades on stock exchanges, similar to individual stocks. It is designed to track the performance of a specific index, sector, commodity, or asset class. ETFs offer investors exposure to a diversified portfolio of assets, providing flexibility and accessibility to a wide range of investment opportunities. ETF structure. ETFs are structured as open-end investment companies or unit investment trusts, UITs. The key components of an ETF structure include creation and redemption. Authorized participants, APs, can create and redeem ETF shares in large blocks called creation units. This process helps maintain the ETF's market price close to its net asset value, NAV. Net asset value, NAV. The NAV represents the total value of the underlying assets held by the ETF. It is calculated by dividing the total assets by the number of outstanding shares. Intraday trading. ETFs can be bought and sold throughout the trading day at market prices. This feature provides investors with liquidity and flexibility. Benefits of ETF investing. Diversification. One of the primary advantages of ETFs is their ability to provide instant diversification. By holding a basket of underlying securities, such as stocks or bonds, ETFs reduce the concentration risk associated with individual investments. This diversification helps spread risk and potentially enhances portfolio stability. Cost-effectiveness. ETFs are known for their cost-effective structure. Compared to actively managed mutual funds, ETFs typically have lower expense ratios due to their passive investment approach. Moreover, since ETFs trade on stock exchanges, investors can avoid certain mutual fund fees, such as front-end loads or redemption fees. Transparency. ETFs offer transparency regarding their holdings. Unlike mutual funds, which disclose their holdings on a quarterly or semi-annual basis, ETFs disclose their portfolios daily. This transparency enables investors to monitor the underlying assets and make informed investment decisions. Types of ETFs. Equity ETFs. Equity ETFs track specific stock market indexes, such as the S&P 500 or NASDAQ 100. These ETFs provide investors with exposure to a broad range of stocks within the index, allowing them to gain market returns without having to purchase individual securities. Bond ETFs. Bond ETFs invest in a diversified portfolio of fixed-income securities, including government bonds, corporate bonds, and municipal bonds. These ETFs provide investors with access to various segments of the bond market, offering income generation and potential capital appreciation. Sector ETFs. Sector ETFs focus on specific sectors of the economy, such as technology, healthcare, or energy. These ETFs enable investors to target their investments in sectors they believe will outperform the broader market. Commodity ETFs. Commodity ETFs provide exposure to commodities like gold, oil, or agricultural products. Investors can gain access to these markets without the need for direct commodity ownership or futures contracts. Risks and considerations. Market risk. ETFs, like any investment, are subject to market risk. Fluctuations in the underlying assets can cause the value of the ETF to rise or fall. Investors should carefully consider their risk tolerance and investment objectives before investing in ETFs. Tracking error. While ETFs aim to replicate the performance of a specific index, there can be slight deviations due to tracking errors. Factors such as transaction costs, management fees, and dividend reinvestment can impact the ETF's performance relative to the index it tracks. Liquidity. While ETFs offer liquidity, not all ETFs have the same level of trading volume. Less liquid ETFs may experience wider bid-ask spreads, which can impact the execution price when buying or selling shares. Investors should be mindful of liquidity considerations, especially for less traded ETFs. Strategies for ETF investing. Asset allocation. ETFs can be an effective tool for asset allocation. By combining different types of ETFs representing various asset classes, investors can create a diversified portfolio that aligns with their risk tolerance and investment objectives. Dollar cost averaging. Dollar cost averaging involves regularly investing a fixed amount of money into an ETF over time, regardless of its price. This strategy can help mitigate the impact of short-term market fluctuations and potentially result in lower average purchase prices. Rebalancing. Periodically rebalancing your ETF portfolio ensures that it stays aligned with your target asset allocation. Rebalancing involves buying or selling ETFs to maintain the desired asset mix, which can help manage risk and optimize portfolio performance. ETF investing offers investors a flexible, diversified, and cost-effective approach to building an investment portfolio. By understanding the structure, benefits, risks, and strategies associated with ETFs, investors can make informed decisions that align with their financial goals. Whether you're a beginner or an experienced investor, ETFs can be a valuable addition to your investment toolkit. Remember to conduct thorough research, consider your risk tolerance, and consult with a financial advisor before making any investment decisions.